Business News, where news for business people.
Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Duggal. Let's get to the headlines this Friday afternoon. Benchmark indices fall the most in over a month as mid-caps and small-caps take a beating. The Sensex Nifty down about a percentage.
The 10-year bond yield hits 7.65 in trade on Friday, but slipped after reports that the RBI will intervene to calm the markets.
It's turning out to be a decent start to 2018 for automakers, with most companies reporting healthy sales growth.
Bajaj Auto and Hindalco, the two nifty companies that will be declaring their earnings today.
A bunch of post-budget voices coming up on the show today. We will, though, first start with the Indian markets and discuss the fall that we've seen this morning. Neelkath Mishra spoke to Bloomberg Quint and gave us his analysis on the math behind the GST revenue targets. We'll get you that view. An FII view on the budget with Arnab Das, and Sajid Chinoy at JP Morgan gives us his assessment of the budget numbers.
But first, the markets. It's not looking good across the board. The mid-cap particularly are taking it on the chin. Neeraj is here to tell us what really is going on.
Yeah, I mean, when you have Reliance, HDFC Twins and ICICI Bank, all of them underperforming, it's little surprise that the markets are doing what they are doing. 3% gashes really for Reliance Industries is steep. But if you just bring up the contributors list, you will see what I'm talking about. The top 5 or 6 names. Also has a Maruti, incidentally, which is down. But look at that. Reliance, HDFC, ICICI Bank, HDFC Bank. And then there's a Maruti at the number 5 position as well. So all of these are down and out, save for ITC, which by virtue of its weight and the percentage gains is doing okay. There's a lot of pain out there. But hey, if you thought that this was pain, look at what's happened to PC Jewelers intraday. Look at what's happened to Vakrangi for the last few days. Look at what happened to Just Style in the session today. And the broader end of the market is bleeding, and bleeding quite profusely. Yes, there is a bit of a recovery from the lows of the day, but that could just be an intraday move, and we could well see this corrective move last going into next week as well. But yeah, there is significant amount of pain in the broader markets today. While yes, the large caps have gone off, I think the story is about what's happening to that mid cap and small cap end of the market, which had run up quite strongly and is now seeing a fair bit of correction. The Nifty small cap index was down 8% intraday, guys. Now it's down about 4%, so a bit of a recovery, as we said. But on a normal day, when you look at a 4% gash, you'll be wondering as to what's happening here, and clearly a fair bit of unwinding. Question mark over what's causing this. Mutual fund people that we spoke to said that they aren't seeing any too many redemptions. So it's not, I think, the domestic institutional investors which are getting out of some of the stocks. This smacks of some bit of retail H&I activity and some deleveraging that could be happening in parts to some of these names.
Specifically on PC Jeweler and Vakrangi, has the market been allayed after the clarification?
Yeah, so Vakrangi, no, hasn't been quite anything. I think the management has just not come out and said anything. And to be fair, I mean, 1, they are under investigation. 2, they have committed the act, which is invest in 2 companies. So there is no. But I think PC Jewelers tried to come out and say that they don't have any control over who buys their shares. They in turn do not have any investments into Vakrangi or any of the other managements. And they are saying it's business as usual. Q3 was strong, Q4 will be stronger. I think it's caught in the eye of the storm ever since this Vakrangi decision was conveyed. And while the markets have punished Vakrangi quite strongly, PC Jewelers have also seen collateral damage. I'm saying collateral damage based on what the management has said. I do not have any extra information about whether there is something amiss with PC Jewelers individually as well or not.
All right, thanks, Neeraj. Let's get into Market Voice. Dhananjay Sinha, head of research and strategist at MK Global, now joins us on this conversation. Dhananjay, thank you so much for joining us on Bloomberg Quint. Before I talk about broader markets, what do you make of the correction that you're seeing today, right now? Mid-cap particularly seem to be taking it on the chin. Is this a much-needed healthy correction?
So I think that's true. Actually, if you look at the mid-cap index, we have been writing about this for almost like 3-4 months. We think that the valuations that had been attained for the mid-cap stocks and indices in particular was significantly way off the mark. So and that is largely because there was a certain amount of idle money that was actually flowing into this space, especially the mid-cap space, and through the mutual funds as well. So I think the buoyancy as far as valuations concerned was significantly high, And after I wrote on 30th September, it rose further. So valuation on a trailing basis for mid-cap index rose to almost like 56 times, and that was almost like more than 100% versus the benchmark index. So clearly there was a very huge amount of robustness that was built in. Historically, the mid-cap and small-cap indices, because of the illiquidity risk that is there inherent in these stocks and indices, they trade actually at discount to the benchmark index by about 12 or 15%. So clearly what would have been, let's say, rupees 85 was traded at more than 200 rupees. So there was a huge amount of valuation buoyancy that was there, and hence with the tightening in the bond yields that we are seeing, there is that liquidity is actually tightening, and some of it is actually flowing back with this whole tax on capital gains that has been imposed is a clear indication that the government wants that idle money to flow back to where it belongs, which is economic activity. So I think that's the critical thing that is impacting the mid-cap index in particular, and hence the correction that we are seeing. So I guess it is not the end of it yet.
Dhananjay, good afternoon. Ira joining in as well. There are actually two macro triggers, right? One domestic and one global. Domestically, there's the change on LTCG, plus there is the higher bond yields, which we've continued to see. And even globally now, bond yields have tightened, which means that equity markets are starting to get nervous. So the confluence of those two factors impacts the mood?
Right. Yeah, I think the bond yields are, see, the thing is why the bond yields is important, and that is again something that we've written earlier, that earlier the valuations were high because you have earnings growth and earnings expectation that is on the numerator. On the denominator you can consider a risk-free rate. So over the last 3-4 years what we have seen, the earnings have not really happened, yet the valuations have gone up. So that's primarily because the risk-free rate was very low. So and there were expectation that earnings will happen. Now what is happening is that the bond yield or risk-free rates are rising much sharper, and globally as well and in India as well. So what is happening globally is also spilling over to what is in India, and there are local factors in India as well, which is important. So clearly the upside that we saw to multiples is reversing with the steep rise in the bond yields, and unless the earnings start to jump up very significantly, that uncertainty will still remain. So we'll have to assume that the growth path starts surprising us positively going forward, for the markets to stabilize and take a positive view even in a rising yield scenario.
What have you made of this long-term capital gains announcement, Dhananjay, and what are clients telling you? Is this part of the par for course? Are there any concerns about it?
So I think over a period of time people will accommodate that, because government clearly wants to sort of take benefit of the fact that the market has been buoyant and there is a fiscal requirement that is there. So people are assuming that over a period of time this is going to be a one-time cost, and eventually people will normalize with their expectation with respect to that. So that's the understanding that the market has. But I think the important thing at this juncture is that the returns are far more important. So if you have a correction of 30, 40, 50% in terms of stock and in stock performance or index performance, or let's say mid-cap mutual fund performance, and on top of that you have a sort of a capital gain also, then it sort of reinforces the downward spiral. So important thing with respect to the mutual fund flows, and especially for the mid-cap space, what we have sort of statistically established is that there is a sort of a positive correlation between valuations and the flows, and each of them cause each other. So there is a bi-directional causality between flows and valuations. Higher valuations attract more flows improve valuations, and this spiral becomes a virtuous cycle. So in a context where it reverses, it becomes vicious as well. So that is my worry at this juncture, especially given the valuation level that the sector had gone into.
The budget is done. What do you think are going to be the next triggers for the market from here on?
So according to me, the whole budget is all about how do you make living conditions of people better? So ease of living is what the tagline has been for the budget. So there is a whole host of things that the government wants to do for the farm sector, for households, for rural sector. This whole Mediclaim thing that they are coming up with. So some universalization of that. And then whole MSME, I guess they're trying to address the stress in the MSME and the farm sector, and also on the job creation front. So there is a whole host of goodies that are contained in the budget. So I guess a lot of these things are inclined towards the fact that you are heading towards the next election. So clearly there is certain amount of entitlement that is there. So where we see valuations or wherever we see where we see earnings visibility emerging is roughly in this space. So I think a lot of agro sector, auto sector, consumer space, a lot of these things will attract flows, or at least my attention is that's where it will be. Also, with a sort of a reflationary bias in the budget intent, at least not so much in the number, but the intent is clearly reflationary, and the numbers will eventually be much higher than what they have budgeted in terms of the total allocation. So I think there will be a sort of a positive spillover as far as credit demand is concerned. So we think that there will be some players, private lenders in particular, who will actually benefit. We are sort of circumspect about PSU banks. And if you'll notice that PSU bank stocks have come back to the same level before the recapitalization announcement scheme was announced. So many PSU banks actually jumped up 40–50%. Now they are back because yields have actually gone up, and you have a prospect of trading profit turning into losses, because trading profit had been contributing more than 100% to the profit before taxes for PSU banks. And that, I think, is exposed to reversal. And also NBFCs, where the repricing of the cost of fund, because there is a very high dependence of their balance sheet on short-term money, especially exposure coming from the mutual funds who have actually been funding in NBFCs. I think if there is a redemption in the money market for the mutual fund, it will also impact the NBFC space and their ability to generate superior margins and ROAs that we have seen over the past couple of years in a situation where the rates were actually coming down. I think that scenario will change quite dramatically for mutual funds, for NBFCs. That's an area again where we will sort of be cautious. We will look at NBFCs which have low duration in assets and who can actually grow strongly going forward. The other space that we would like to look at is where the government has actually increased custom duties for domestic manufacturing, especially in the consumption space. There is a whole host of stocks that we have identified who come within the ambit of this protection that the government is trying to come up with. So I think this is a whole host of things that we have sort of been telling to our clients. The other space, of course, is that there is a high amount of allocation in the that has happened to infra space, especially the roads and railway sector.
All right,
so that's the last bit, yeah.
All right, Dhananjay, thanks so much for listing out some of those interesting spaces and also highlighting what the macro changes in the market's mood are. So that's the equity markets for you. I just want to spend a couple of minutes describing what's happened in the bond markets. First, pull up the intraday. Now, earlier this morning, when markets opened, the 10-year yield had moved up further. In fact, the new 10-year had moved up closer to about 760, 465. Then there were some local wire reports that came through which suggested that the Reserve Bank of India will intervene both on the secondary market side and via open market operations, and the impact of that is visible on that intraday chart. As you can see, yields have cooled off substantially, coming in now closer to about 750. But the broader picture for the bond markets and the reason why the Reserve Bank may now need to come in with some sort of policy intervention is the fact that the budget has done more harm to an already bad situation in the bond markets. That is reflected in this chart, which compares the repo rate the underlying RBI repo rate to the 10-year bond yield. And if you pull that up, you'll see that with the exception of the global financial crisis period, where there was a significant gap between the repo rate and the 10-year yield, this is perhaps the widest the gap has been all the way since the start of 2000. Why is that important to focus on? Because you should not have such a significant risk premium built into the government bond yield, particularly at a time when, yes, inflation is picking up, but it's not like we are expecting a spike in inflation. Growth is picking up, but moderately. So this kind of a sort of spread was perhaps not justified. And given that the government didn't really do anything by keeping its fiscal position in check, the RBI will have to do some sort of intervention, perhaps to cool markets, or at least just calm markets, and then markets can go back to trading a little bit on fundamentals, because right now a little bit of that negative mood is sort of feeding it into itself. The reason I say that the government hasn't done anything to help the situation is because there are two things to focus on here. One is, of course, the gross borrowing number, which actually came in lower than what was expected. So people were talking about a 6.5 lakh crore number. They said 6.06 lakh crore. But if you look at a number of reports that came in this morning, there are people who are saying that that 6 lakh crore number may see some upside risk during the course of the year. So that's one thing. And the second thing is slightly more medium term, but it's extremely important to focus on that the government has not only not endeavored to meet the 3% fiscal deficit target in FY19, they have now pushed it all the way to FY21. So the medium-term fiscal policy has also loosened a little bit. The fiscal deficit, will only hit 3% in FY21. Revenue deficit, they've given numbers, but they've said they'll stop targeting revenue deficit entirely, which is, negative from somebody who's watching the quality of fiscal consolidation, because even last year it was the capital expenditure that took a hit and the revenue expenditure continued to surge. Finally, they have said that they will in part accept the NK Singh committee recommendations and bring down their debt to GDP ratio. But again, the NK Singh committee had recommended that the debt to GDP ratio of the centre be brought down to 40% by FY23. The government has taken another 2 years and said we will only do it by about FY25. So all those put together, along with the nervousness that persisted in the bond market even before the budget, is perhaps the reason that markets saw another sell-off, at least in early morning trade. Now, apart from that, we're also, all trying to assess the mathematics behind the tax projections in the budget, the expenditure numbers in the budget. There was some skepticism about the tax projections, suggesting that perhaps they're a little aggressive given the early experience under GST. But we spoke to Neelkant Mishra of Credit Suisse earlier today on Bloomberg Quint. He did the math for us literally in the studio, and he thinks it makes sense. Listen in.
In the budget numbers, there is CGST of 6 trillion. There is IGST unallocated of 0.6 trillion. You have a cess of about 0.9 trillion, right?
Yeah.
Now, you add these up, you get about 7.5 trillion, which is the center's assumption.
Yeah.
This becomes expenditure as well, right? So it goes down. What people are doing is they are saying, let's assume this equals SGST. So you add another 6 trillion, you get 13.5, right?
Yeah.
This equates to a monthly rate of about 102,000 crores, 112,000 crores.
Correct. This
Right.
13.5 would correlate with the 10.6 that you're talking about, plus growth.
Yes, but
Correct?
we'll come to this
fine.
year's number
Okay,
very soon. So this is the.
So the ask rate of GST should be 1,12,000.
No, this is what the market is currently assuming.
Okay.
Right? Now let's look at the numbers. The average, so this is FY19, right? Now FY18.
In case he wants, wants a different colored pen.
So
pen for FY18.
thank you. So FY18, the average number disclosed is about 87,000 crores.
Yeah.
Right? So people are saying, oh my God, this is like a massive growth assumption, right?
Yeah.
And this is the clear problem in the bond market, right?
Yeah.
There are two problems here. One, this equality that SGST equals to this is wrong. Secondly, this is wrong. Why? See, there is what the government disclosed, say for July, is like 92,000 crores or 300, in the first month after that. There are a lot of people who paid GST after August for the month of July. For the month of July, that number is not being updated. If you add up the cash collected, because this is what comes in the CGA accounts, the cash collected 5-month average is actually 96,000 crores.
Okay.
So it's about 10% higher. On this base, this target looks reasonable.
Fair enough.
Right?
But even then, this is not the target you're saying.
Exactly.
Yeah.
Now, the issue is that CGST will not equal SGST, because what is happening in IGST unallocated is this is 1.6 trillion in FY18 in the RE number. Right? Now, this drop of 1 trillion is getting added to this 6 trillion number, right?
Yeah.
Because it will get allocated to CGST and SGST.
Yeah.
The unallocated, so in this 1 trillion, the unallocated SGST is a lot lower than unallocated CGST. The reason for that being that in theory, IGST, when it is collected, is equal SGST and CGST.
Right.
But so far, in the first 5 months, the allocation of IGST to SGST has been far higher than the allocation to CGST.
Okay.
Which means that this is not to be equally distributed between this and this. Which means that this is likely to be more like 13.1 or so.
No, which means that the 6 trillion that you're referring to as the CGST is actually a higher number. Is that the right way of understanding it? No?
Don't add 6 trillion here, is my point. It will be more like 5.6 or something that you should add here.
Okay.
Right? Because a large part of this unallocated as IGST is actually CGST.
Okay. From this year?
Yes.
From this year?
Yeah, because see, when this 1.6 is dropping to 0.6 means that incrementally 1 trillion is being allocated to SGST, CGST.
But it's revenue from this year which will be allocated next year.
Yeah, but okay, from a cash flow perspective, IGST will keep getting accumulated.
Yeah.
So if you see aggregate IGST calculation collection, the unallocated part will drop by the end of the year, but hopefully the government's mechanism for allocation will speed up. And as it drops, incrementally of this 1 trillion, which is the excess from this year, the allocation to CGST will be far higher than that for SGST. The moment you drop it to 13.1 or so, you're talking about a 107 kind of number.
Okay. So that's the ask rate for next year.
Sorry, 110 or something. And this growth is actually 13-14%, which is not very aggressive at all.
So you're saying that the ask rate in terms of monthly GST collections for FY19 is actually 1,10,000 or something like that.
On a base of 96,000.
On a base of 96,000 for FY18, which suggests about a 13-14%.
13-14 on this. Actually, when we had done the numbers with the decimals and all of that properly, it came to about 11.5%, which is actually absolutely the nominal GDP growth.
Neelkanth Mishra of Credit Suisse. Numbers flashing on your screen is of Hindalco. Net profit standalone has come at 377 crore on an estimate of 501 crore. The revenue numbers have come in at about 1,002, if I'm not wrong. Looks like this is in line with expectations, but we'll wait for Nikki to come and give us a perspective on how these numbers have performed. The stock is falling marginally at this point in time as we speak, about 1.5%. Actually, it's been down about 1.5% since morning. That's Hindalco for you. Net profit standalone is at 377 crore as opposed to 320 crore. All right, let's move on. The government has also high customs duty on around 50 items, which include products like perfume, diamonds, semi-precious stones, and car parts, in order to incentivize imports and in what it hopes will boost the Make in India program. Purva Chitnis is here with a list of prominent products that will attract higher duty from here on, from the 1st of April, that is. Purva.
Yes, with the proposed increase in customs duty on certain imported items, it is going to have some impact on the cost, where these items are going to get more costlier. One of the important categories is the edible vegetable oils, which include your groundnut oil, olive oil, cottonseed oil, where the new duty is raised to 30% as against an earlier 12.5%. And on the refined oil of the same kind, the new duty is gone up to 35% from an earlier 20%. Also on your imported mobile phones and smartwatches, the new duty is 20%, and similarly for the LCD LED panels, the duty is raised up to 15% from an earlier 7.5%. The duty for the cut and polished gemstones is now at 5%, while that of imitation jewelry is 20%. In the processed food categories, your favorite orange juice and cranberry juice is also set to become more costlier, as the duty on the orange juice is now 35%, while that on the cranberry juice is 50%. In the auto ancillary part department, the specified parts and accessories is now at 15%, and the completely built units of motor vehicles is at 25%, while the radial tires of the trucks and buses is now at 15%.
All right, Bloomberg Quint's Nikunj Ohri caught up with the Finance Secretary and asked him about some of these customs duty hikes, the rationale behind them. He also spoke about the rejigging of excise duty on petrol and diesel. Listen in.
As far as the current change in today's budget, that is only nominal. From the viewpoint of consumer, there is nothing that changes. We have taken some part of the excise duty to cess so that we allocate it for specific purpose of education and health. That is the purpose. But when it comes to deciding about the future course of action, we will take suitable action if the need arises. We have done it in the past. Very recently, we reduced the price, the excise duty on petrol and diesel by 2 rupees, if you remember. And that resulted into annual loss of 26,000 crore.
And sir, what is the price of oil prices assumed in the budget? Is that a range that you assumed, or is there a specific?
No, we haven't assumed anything in the budget. What we are assuming is that we will not have to do any alteration in the duty rate. While projecting the budget, we have not accounted for any decrease that we may have to do of the excise duty.
And sir, you've also increased customs duty on many products like mobile phones, television sets. So although the moral behind it is to promote making in India, but it is some sort of a burden on consumers now. So what went into this thinking?
Well, it's not really a burden now. Some of these items of electronic goods are used by relatively rich class of people, the smartphones and things like that. Feature phones are already made in India only now, so they are not going to become expensive. So our purpose is to drive all these smartphone manufacturers to come to India and manufacture it in India. That's the idea.
That's the Finance Secretary justifying the decision to impose those custom duty on a bunch of products. But let's focus and talk about earnings. We were talking about Hindalco, net profit is 377 crore. Standalone net sales is about 11,022 crore. On the face of it, it looks like it's above expectations. That's the stock for you. It's still trading lower and going further lower at about 1.5%. The EBITDA has come in at about 1,300 crores. Nikki is standing by with a sense of why or how these numbers have actually done. Nikki?
Yeah, so we're looking at in line with expectation kind of operations coming in from Hindalco. It's a 5%, a little miss from what we were estimating, but then almost in line with what we were estimating. If you look at the net sales growth, it's a 18% jump that we're looking at year-on-year basis. The number has come, as you just mentioned, at 11,000 odd crore. EBITDA at 1,311 odd crore is almost in line with estimates. However, we are looking in a decline coming in on the profitability front. That is a 377 crore kind of number that we are working it on the pad. That's a good 17.65% growth. The numbers have seen some miss coming in on the bottom line. But if you look at the segmental performance, that's the alumina EBITDA business, which has grown by 7% year-on-year basis at a number of 940 crore, is pretty much in line with what we were working with. This is one number that I would want to personally keep an eye out for, because we were expecting some sort of cost pressures coming in on this division. And copper EBITDA at 421 crore has registered a 28% year-on-year increase, which is also more than what we were estimating. We were working with a number of 350 odd crore there. Novelis, as we just know, has actually achieved a good number, a good guidance that the company reported overall. So overall, I'd make it out to be a good set of numbers. A miss on bottom line performance is on account of exceptional item, but then otherwise, it's a good set of numbers that we're looking at, in line with estimates.
All right, Nikki, we'll let you go to a slightly deeper analysis and come back. We'll slip into a quick break. FI view on the budget with Arnab Das of Invesco coming up on the other side.
बढ़ते समय के साथ बढ़ती सुरक्षा का वादा। LIC की जीवन प्रगति पॉलिसी, जिसमें बीमा की अवधि में हर 5 वर्ष बाद अपने आप जोखिम सुरक्षा की राशि में बढ़ोतरी होती है। LIC की जीवन प्रगति पॉलिसी।
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
More than just business news, we're news for business people.
Welcome back. You're watching Power Lunch. Let's dip back into the headlines. Benchmark indices fall most in a month as mid-cap and small-cap stocks take a beating.
The omission of the grandfathering clause for LTCG levy for overseas investors leaves FIIs confused.
The government defers the implementation of the e-way bill requirement to carry e-permits for interstate transportation of goods due to technical glitches during trial runs.
We're all watching out for Bajaj Auto and Hindalco, two nifty companies coming out with earnings today.
All right, but let's first go back to the markets. About 1.5% lower now on the Sensex and the Nifty. Pradeep Pandya joining us with what's moving the markets. Pradeep, what's the action?
So actually, if you look at it, yesterday we kind of recovered from lower levels, but after that, since morning, it was very clear that SGX was down and global markets were not doing well either. So it's a mix of global and local, and some people believe that maybe a lot of global, but also another key point here would be that small cap index had already fallen by 10% and mid cap by around 5% till yesterday, and that building on that. So in that scenario, some traders believe that there could be some kind of pressure building in already on the traders to hold on to their any leverage position, and it could also be an indication of that. What kind of confirms you is the panic selling that we had seen in stock like PC Jewelers in the morning. And then look at the high beta names like entire ADAG group, the way they are suffering. That kind of tells you that there is some bit of pressure in mid-cap space, and people are not really able to hold on to their positions, maybe. And then if you look at the large cap, you have mainly banking and real estate, the so-called rate-sensitive segments suffering because of the yields moving up, because that is yet another concern. Not only in India, but interestingly, globally now, even the US yields have moved up quite a bit, and 30-year crossing, 3% after 8 months or so. That's again kind of a concern. So all these factors have contributed to the sell-off, but as we speak to brokers, they are worried more about the mid-cap and small-cap side, because the real pain is now kind of building up.
All right, thanks so much, Pradeep. Pain in some stocks and macro changes to the environment as well.
Okay, it's been 24 hours since Finance Minister Arun Jaitley presented Budget 2018. India Inc. economists and market experts have finally had a chance to digest the different proposals and projections put forward by the government. Some have raised concerns over the fiscal math, long-term capital gains tax and high taxes on large corporations, while others have lauded the government for trying to manage a multitude of headwinds with a conservative statement of accounts. JP Morgan's chief India economist Sajid Chinoy calls this budget a realistic one given the economic headwinds faced by the country. Listen in.
government kind of walked a middle path. Rarely can I remember a budget where there were so many pulls and pressures and so many constraints. So I think to limit the slippage to 0.3% is not such a bad outcome, especially given the fact that the government didn't have access to the 12th month of GST revenues. Now, as you pointed out, there still are some uncertainties here. I think for FY18, apart from the RBI dividends, even some of the indirect taxes related to GST would need to grow quite strongly over the next 2 or 3 months. But, I think having printed this number of 3.5%, I think the government will do what it has to do to keep at 3.5. And therefore, if the pressure increases, I think expenditures will be cut in the month of March because this is a cash accounting system. So I don't doubt the fact that the FY18 outcome will be at 3.5. The good news, I think, is FY19, having a smaller consolidation is much more realistic, much more tenable. Some in the market had called for a 0.5% of GDP consolidation from 3.5 to 3, which would have been very hard to achieve in a pre-election year. I'm very positively surprised by the expenditure restraint. What you see is current expenditures are growing much less than nominal GDP, and therefore they come down as a share of GDP by 0.2%. So the entire consolidation next year is on the back of current expenditures being cut, which is very admirable restraint. CapEx is maintained at the same level. If there is one area where there's some uncertainty, I think it's on GST revenues, because if you look at the numbers on the central GST, the government's assuming a very large pickup. Now, undoubtedly, one has to make some adjustments here because it's a new regime. IGST revenues are high this year. They're small next year, and some of that gets allocated to CGST. So, without getting too technical, it's fair to say that for next year's number to hold, one will need to see reasonable buoyancy on the GST front, a much higher compliance than this year. We're still very hopeful that happens because once the e-way bill goes in, I think that will broaden compliance quite meaningfully. So I would say that, it's a credible consolidation based on expenditure cutting. The only real uncertainty is GST. Because if those revenues don't materialize, it'll be hard for the government to slash expenditures in a pre-election year, especially when that growth rate has been quite constrained to start with.
So, Sajid, you're saying that the net tax revenue numbers, you're not sure about how those will add up. And on the expenditure side, is it realistic to say that they'll be able to curtail expenditure to the extent that they're suggesting they will next year?
I think one has to separate the subsidy component from the other expenditures. This government's track record has been very good on this front, that we haven't seen large expenditure overruns in any of the last 3 or 4 years. I think the one area is going to be subsidies, that the fuel subsidy is budgeted the same as this year. If oil prices remain high, that puts some pressure on fuel subsidies, that puts some pressure on fertilizer subsidies. If the MSP promise is implemented, that pushes up food subsidies a little bit. But then again, I think there are offsetting and mitigating factors here. Remember, disinvestment next year is targeted at 80,000 crore. This year, the government hopes to get 1 lakh crore. So again, I think if some expenditure components were to overrun, there are other buffers the government may have. I don't think outside subsidies, suddenly the government will wake up 6 months into the year and budget significantly higher expenditures. I think the risk to the deficit stems much more from the revenue side and on the GST side in particular.
Okay. Sajid, you're comfortable with the medium-term fiscal framework that they've spent out? I mean, they're now targeting 3% only in 2 years from now, and even the recommendations of the NK Singh committee that they've accepted, they seem to have accepted them, in part, right? I mean, they've extended the timelines. Even on the debt to GDP, they're saying till FY25, and I think the committee had said FY23. So have they not been fairly selective in, what they want to accept on this fiscal roadmap?
I think one has to take into account just what the whole transition year has done, because I think if it had not been for the move to GST and the revenue pressures arising from that, I think the government would have stuck to 3.2% this year and stuck to 3% next year. So I think I'm certainly willing to cut the government some slack on that front, that if those timelines get pushed out by 1 or 2 years, I'm not sure that that's going to fundamentally change things. I think it's actually very positive that the government has adopted that debt to GDP anchor, because I think what the bond markets need today, and we saw another bond sell-off today of 15 to 20 basis points, desperately is an anchor. I think what we've lacked in the last couple of years is a fiscal anchor, and so every year people are guessing what that year's deficit is going to be and what the next year is going to be. I think now, I think the key here is GST. That if FY19 is the year where GST revenues stabilize, there's more confidence that the buoyancy is at least as large as the government believes, then I think going forward to consolidate from 3.2 to 3 and stick to 3 appears much more believable. So I think, I think it's a good thing that they've adopted those recommendations, because that gives the market a much-needed anchor, without which risk premia in the bond market had increased very dramatically over the last 5 or 6 months.
Okay. Sajid, one more question on the fiscal side, and then, just want to get to some qualitative aspects of the budget. So does this complicate the inflation and the interest rate scenario, both from the RBI perspective, but also the markets? As you pointed out, you had another sell-off in the bond markets today.
I think from an inflation perspective, I think the fact that the government's consolidating will help at the margin. I think the biggest kind of uncertainty or risk here will be minimum support prices. Now, there again, there's some uncertainty if the government, how quickly it moves to increase MSPs to be 1.5 times the production cost. If you look at the CACP, there are 2 different kinds of production costs. So which production cost will you use? And if you take a cursory glance at it, many of these MSPs are quite close to 1.5 times. It's only paddy or rice, which is about 38% now. So if you mechanically say that that has to go to 50% immediately, given the weight of paddy in the CPI, that could add, somewhere around 70 basis points. But again, I think we're jumping the gun by, so quickly. Let's wait and see how the government chooses to implement these MSP increases. Is it staggered out across a year or so? Is it front-loaded? What is the quantum? What is the production cost that's assumed? But I think that's the key risk here, apart from the elephant in the room, which is oil prices. And I think one worry has been that if you look at core inflation correctly measured in India, headline adjusted for food and fuel and petrol and diesel and even housing, that core momentum has been 0.5% month on month for the last 4 months. And this cannot be attributed to GST, because this is September, October, November, December, when GST rates were being cut. So that's an annualized momentum of 6%. So I think that's what's going to keep the RBI cautious here, that if core inflation is already tracking an annualized momentum of 6%, and there is reflation to food prices from higher MSPs, that will not make for a good combination.
Sajid, what did you make of the broader sort of, they tried to project it as a rural-friendly budget. So apart from this MSP, they had that, health protection scheme, although I have to say that they only allocated, I think, about 2,000 crore to that health protection scheme. Yes. And if you look at the other rural schemes, there isn't much of an increase in Manrega. There isn't much of an increase in the Awas Yojana. So, they projected it as a rural budget. Is it a rural-friendly budget?
I think it's a responsible budget given the fiscal pressures we spoke about. And I think, at least from a macroeconomic stability perspective, I'm very impressed by the expenditure restraint. I think the expectation was in a pre-election year, you'd have expenditures going up easily more than nominal GDP, and people said if nominal GDP is going up 12%, expenditure growth could be 15-16%. The fact that expenditure growth is at 10%, in fact, if you take out the transfers to states, which count as expenditures, it's 9%. And all the consolidation is being achieved by cutting current expenditures. I think that's very admirable. So while there were lots of schemes announced, the allocation has only gone up by 8 or 10% in most cases, which I think is very responsible. The second part is, apart from the MSPs, I think one of the signatures of this government is the focus is very much on infrastructure. So to the extent that these are supply side productivity enhancing investments in the rural economy, over time they certainly will help growth and also become disinflationary. So I took that to be a positive, that while the intent of the speech was to boost the rural economy, the allocation was quite conservative.
Okay, what did you make of the announcement of this health scheme? Something like that, especially if they want to move towards making it universal, would be prohibitively expensive, would it?
Prima facie, yes. I think any universal scheme, I think we have to find a way to means test these schemes. It has to be rolled out in a pragmatic manner where you don't get many leakages. I do think we need much more government spending on education and health. I think we focus so much on physical infrastructure, but if you look at how much the public sector spends here on education and health, we're woefully short of where we need to be at this level of income and this level of development. So I welcome any expenditure or any insurance mechanism for health. But I think you need to balance that with what the cost is going to be. So I would like for it to be well thought out, limited, means tested, and then implemented.
Sajid Chinoy from JP Morgan. Let's talk about earnings now. Bajaj Auto's numbers flashing on your screen. 1,013 crores on the bottom line. Top line is about 6,369 crore. Yatin is standing by to tell us what on the face of it looks like pretty decent set of numbers. Yatin.
Numbers on the revenue front are largely in line with the street expectations, but if you look at the operating performance, that has been slightly below the street expectations. In fact, we were expecting the EBITDA margins to be close to 20%, and they have come in at 19.3%, despite the fact that we had a higher share of export growth as well as three-wheeler growth. And despite that, the margin performance is subdued. So if you were to remove that, probably the motorcycle business or the main core business on the operating front has not really done well as per the street expectations. In fact, if you look at the net revenue, that saw a growth of a smart 26%. EBITDA growth on an absolute basis was 18%, more or less in line with expectations. But if you were to look at it from the top line front, clearly the margin is a miss at 19.3%. Net profit coming in at 952 crores, a growth of only 3% on a year-on-year basis. Numbers, look slightly muted on the operating front. On an overall basis, it's a result slightly below the street expectations.
All right, Yatin, thanks so much. That's a view on Bajaj Auto. Numbers have just come in. Let's get back to the budget and speak about perhaps some other aspects of it. We've spoken to a whole bunch of people over the last 24 hours or so, various aspects in focus, in particular the kind of MSP increases that have been talked about, whether those will prove to be inflationary. Not everybody believes they will. In fact, we got a contrary view from Ridham Desai of Morgan Stanley as well, and he talked about the fact that he actually thinks that the focus of this budget is slightly anti-inflationary. So he thought that the reason that they've kept spends down is because they want to try and curtail any additional inflation pressure which builds up on top of already rising inflation. Let's hear out what Ridham Desai of Morgan Stanley had to say on some aspects of the budget.
My argument all along the way for the past 15 years, since 2004, is that if you're taxing dividends, you have to tax capital gains, because capital gains is nothing but future dividends. It's an anomaly that you tax dividends, which is correct. So what you are incentivizing firms is to delay all dividends. Don't pay dividends because dividends are taxed, arbitrage them because capital gains are not. Okay? That behavior did not come through in corporate India because corporate India does not on an aggregate basis get this point, but that's what the tax laws were doing. So it's only fair to bring capital gains under taxation. There should not be any income stream, independent income stream that is not subject to tax.
Yeah. So no,
so eventually even farm income should become taxable. Eventually.
Hopefully at some point of time, some government has the gumption to do that. But the question only is from a flows perspective again, and you can argue that the last 6 months, it's not been really gung-ho, the FI flows, except for January, which was strong. But FI after FI has made a point, and I want your opinion out there, that would India stand out as a sore thumb amongst a lot of large Asian countries which do not have this tax from an FI perspective? Or do you think that the growth will be strong enough that people will find merit in investing because the 10% tax on gains really won't change investment behavior?
So Neeraj, the tax issues around FPIs is not a new thing. I mean, agreed. This is one new angle, but it's been persistent for the past 25 years since they came to this country in 1993.
Sure.
It's never prevented them from buying stocks.
Okay.
Because ultimately you buy if you think markets are going up and you take care of the tax. If you're making money, you're happy to pay the tax. Certainly there are some accounting issues and admin issues around this which people will have to sort out, and that's a headache. it's an extra headache for people and that will irritate them. But if somebody told me that the markets are going up 25% in the next 1 year, I'd worry about the tax later. I'd first buy the markets. So I don't think India loses out on account of that. But yeah, certainly we have a more transparent tax regime will help bring some peripheral investors who stay away because they don't want to deal with India's tax issues.
And I suppose the government has the comfort in the fact that over the last year we've seen domestic money actually support the markets a lot more than FII money has, right? So I think to some extent they're probably hopeful that this is not going to sour the mood considerably on that front.
Yeah, also FPI flows are not a function of just India. So there's an emerging market angle to it. Sure. And if the SGX is down this morning, it's got nothing to do with the budget. Right? So we should not fall into this trap. In fact, I think 80 to 85% of what the Nifty does in the next 3 months has nothing to do with India. So we can keep printing our growth numbers and our capex numbers. The market will do its thing because the Dow Jones will do its thing. And if the Dow goes down, the Nifty will have to fall. It doesn't matter. Look at this earnings season. It's been a big surprise. 3 out of 4 companies have surprised the analysts. Yet, only 1 out of 3 stocks have gone up after the earnings.
Well, maybe the
market doesn't want to go up because there's pressure on the SPX and there's a little bit of a nervousness out there in global equity markets. So there's no bid left here.
Okay, I just wanted, I was reading your note as well and just throw in one question as well, since you talked about how markets could do. You've gone ahead for infrastructure owners, corporate lenders, software, which you have been bullish on, to be fair, for a while now. Yeah. And this is, I thought, in stark contrast to not a stark contrast, but a bit of a contrast to the large list that you preferred when you came out with that amazing report on India's digital leap as well, which was pro-urban consumption, pro-corporate lenders, pro-non-corporate lenders, HDFCs, Kotaks, etc. Yeah. So is this...
No, that's a 10-year view. That's a 10-year view. This is a 12-month view. So we should not mix up. Yeah. I think the next 12 months, it's a good environment for corporate lenders. Do you want them as compounders for the next 5-7 years? Probably not. But can these stocks go up 30-40% this year? They can.
And infrastructure owners?
Yeah, I think that also is possible because I think the economy is picking up and growth is picking up. So infrastructure, industrials will do well this year. And likewise with corporate lenders, I think NCLT process is gathering momentum. There's a further tailwind from the budget, which reconfirms their intention not to tax or to provide tax protection to accumulated losses. So I think that will help the corporate lenders. So it's a cyclical or I think a 1-year call versus a 5 or 10-year view on India. Okay. And we continue to stay constructive on consumption. So there's no let up on that. I think, I just found my focus list loaded with rural names, and yesterday all of them were doing their jig. Yeah. So I think that also is the case for the next 12 to 18 months. That rural-oriented consumer companies should actually do quite well because the rural economy is picking up after a few years of pain. Because when the Modi government assumed office in 2014, the first thing they did was they crashed rural wages. So Manrega spending went through a restructuring. It became a public works department from being a wage distribution program. And that's what helped stem inflation. That was their contribution to inflation. And wage growth, which was running in the low 20s, came down into almost at 0. Imagine the amount of pain rural India had to go through. So I think that pain is also behind us.
Rhythm Desai of Morgan Stanley. Out of time on the show. Thank you so much for joining us today.